Okay. So examples include loans payable, bonds issued by the entity, and accounts payable. Then equity is the residual interest in the asset of the entity after subtracting all its liabilities. Okay. Examples include companies, common stock, preferred stock, and returned earnings. Then equity is affected not only by operations but also by transactions with owners, such as dividends and contributions. What happens to the equity? When you make profit, definitely your return earnings will increase. When your return earnings increases, your equity will increase. Then if you are issuing more shares, then also your equity will increase. Or you are giving dividends, then your equity will change. Equity will reduce. Clear? Then in the balance sheet, we segregate assets as well as liabilities into two categories as current and non-current. Okay. The assets are generally reported in the order of liquidity. That means you will first report the cash, bank, then receivables, then inventory. The order goes like that. Then, in some parts of the world, assets are listed in the order of reverse liquidity, with intangibles and properties, equipment listed first. This is known as production order. This method is not used in US. I think in Australia, they use the solvency order. Clear? The reverse order they use. Now, let's go through each of the items here. Under the assets, we have current assets and non-current assets. Under current assets, we have cash, then certain investment which is equivalent to cash, then accounts receivable is there, inventory is there, prepaid expenses are there. Then non-current assets, we have certain investments and funds which we have done for long-term. We could say long-term investments, then property, plant and equipment, then intangible assets and other non-current assets. Then coming to the liability side, we have current liabilities and non-current liabilities. Current liabilities is accounts payable, then current notes payables, then current maturity of non-current liabilities. Have you heard this? Any of you is not familiar to this? Hello, you can speak up. Anybody?
Maturities.
Hmm.
Yeah, but I don't know.
Okay.
When maturities, current maturities.
Current maturities of what? Loans, right?
That's what it means?
Yeah. So, for example, you are having a loan, which is give me 1 second. Let me clear this person. Training what are അവിടെ ജോലി ചെയ്യുവാണേ കേട്ടോ എവിടെയാടാ ഈ സാധനം ഏതെങ്കിലും എടുത്തോണ്ട് പോ പിക്കപ്പ് ഓക്കെ ടേക്ക് ഡോർസ് ആണ് sorry guys. So current maturities of non-current liabilities means, for example, you are having a loan for 500,000 from a bank. So which is a 5-year loan, for example. And every year you are paying 100,000. So this year, when you prepare your balance sheet, what you have to do is the liability sessions. You can see the Excel sheet, right?
Yes.
You have current and non-current. So here, loans, current portion you have to show here. $100,000, and rest of the 400,000 we will show under loans. No, go and go. Okay. Okay. So this is how we present. Clear?
Do we have to do this for assets as well?
Not for assets, only for liabilities. Okay.
Okay.
So So when you say assets, there are a lot of other assets, right? We not assets, liabilities. We have leases, right? In the leases also we
Yeah.
have contract liability. So contract liability also we have to split it, current and non-current. Bank loans, you have to split it. Clear?
Okay.
Okay. Then comes non-current liabilities, which is non-current notes payable and bonds payable. So what happens to the bonds? Bonds means bonds, debentures, and all this comes under this heading. Here also, what happens is we have like a 10-year bond. Okay, so it's
Mhm.
a term bond. Then that bond's repayment, whatever we are having, that also we have to show it as current and non-current. Clear? Then in the equity, we have common stock and retained earnings.
Just one more question.
Yep.
Is this being done because we need to show how much is the current liabilities, like how much working
Yes.
capital would be required?
Yes, that's true. Because next year we need to plan, right? We need to know how much liquid cash we need to have. So to get the
Okay.
current asset ratio, quick ratio, and all, we need to separate it.
Okay.
Because next 12 months we have to pay this amount. So we need to have the fund for that. Clear?
Okay.
Okay. Now going forward, current and non-current. How we will classify an item as a current and non-current. An asset is classified as current on the statement of financial position if it is expected to be realized in cash or sold or consumed within the entity's operating cycle or 1 year. Now, so for example, you're having inventory, we should be able to sell it and get it as cash, or either you can recover it as cash. Like for example, there's an investment, short-term investment is there. You sell it, you get it as cash, or you have inventory, you can sell it. Okay, then it becomes an accounts receivable, or you should be able to consume it. That's why the raw materials all comes under inventory and under current account, current asset. Clear?
Yes.
Now, operating cycle or 1 year, whichever is longer. Normally, normal cases, what happens if you're into trading business and all, your operating cycle will be like 60 days or 30 days, kind of. What is an operating cycle basically? Any idea?
No.
Okay. Operating cycle is when your business transaction starts. For example, in a business transaction, what we do, we go to a vendor, we purchase, right? Right?
Yes.
After this 30 days, we pay, for example, there's a 30 days credit, we pay them, pay to vendor, right? Then we will have the inventory with us. Okay. Uh, inventory we are having. We will be keeping this inventory for example, 30 days. Okay.
Okay.
Then after 30 days, we sold this inventory to a customer. And for the customer also, we give like 30 days credit. Okay.
Okay.
So this transaction, this whole process is called the operating cycle. Okay. You purchase, you kept in the inventory, you sold to a customer, and you receive the money back. Got it?
Okay.
So that's a operation cycle. Next, there is something called cash cycle. Cash cycle starts when you pay to the vendor, then you collect from the customer till the customer collection. Got it?
Yes.
So the cash cycle will be lesser than the operating cycle. Got it?
Yes.
Okay. Now, so here in this case, we might be taking maximum 60 days or 90 days as the operating cycle. Then operating cycle or 1 year, whichever is longer. Clear? Now,
Okay.
second scenario. If you are into a construction business or something, and your operating cycle is like 15 months or 18 months. Got it?
Mhm.
For example, you're manufacturing aircraft. So it might take like 18 months to complete an aircraft.
Yeah.
So then such cases, the operating cycle will be 15 months or 18 months. So current assets means 18 months you will calculate. Clear? It's not
Okay.
1 year. Got it? You're getting that?
Yeah.
Okay. Now, so following are the major categories of current assets. One is cash and cash equivalents. Then certain individual trading available for sale and held to maturity debt securities. So now all these three items. So individual trading securities means, for example, you might have brought shares of other companies as part of your business. The main business is that you're a stockbroker, for example. You buy and you sell shares. So that becomes as an individual trading shares or debt securities. Got it? Second one,
Yeah.
available. Before that, I will say what is held to maturity. Held to maturity debt securities is friends. For example, you have brought some other company's bonds or debentures. Okay. So when you purchase, you have an intent to hold this debentures or bonds till the maturity date. So your planning is to hold this so that you get interest every year, and at the end of the period, term period, you get the money back. So that is the basically called the held to maturity debt securities. Clear?
Yes.
So this securities, what happens later on? Sometimes you decide that okay, we are not going to hold till maturity. We will sell it. Clear?
Hmm.
Then these securities will become available for sales debt securities. Clear? So
Okay.
these securities will fall under current. So that's why we say that certain individual trading securities and available for sale and held to maturity securities will come under current assets. Clear? Not all, only certain securities will come there. Then comes the receivables, then inventories, prepaid expenses, then certain individual investments in equity securities. Now, that is what certain individual investment in equity securities means. You have invested in some other company, but your intention was not to take the control of the other company. Clear?
Hmm.
Uh, so you brought, like, for example, you brought like 100 shares of Google or Microsoft. In your books, you will show it under current assets. Clear?
Why?
Because you are not going to, you will be selling it in the near future. If you're holding it for like more than 50% shares or voting rights you're having, or you're purchasing the shares for control, then you will never sell it, right?
Yeah.
These securities, you brought it for return dividends or maybe for the capital appreciation. That's why we show it under current assets. Clear?
This held to maturity debt securities,
Yeah.
it has to be less than 1 year.
No, the debt securities, for example, you purchased, maybe it's a 10-year bond, but you purchased in the last 9 months or 9.5 months, after 9 years you purchase, then it becomes your current asset. Clear?
Okay.
Okay. Now, going forward, then non-current assets, long-term assets are those not qualifying as current. Okay. The following are the major categories of non-current assets. That is, investments and funds include non-operating items intended to be held beyond the longer of 1 year or the operating cycle. The following assets are typically included. That's investment in equity securities made to control or influence other entity and other non-current securities. Clear? For example, you
Yes.
have invested in another company to make it as a subsidiary, or you are having a more than 20% shares in another company, then it will fall under non-current assets investments. Clear?
Yes.
Then certain available for sales and held to maturity debt securities may be non-current. Okay. Then plant property equipments PP are tangible operating items recorded at cost and reported net of any accumulated depreciation. They include land and natural resources subject to depletion, example oil and gas reserves, then building equipment, furniture fixtures, leasehold improvements, land improvements, lessee's right to use of asset held under finance or operating lease, non-current assets under construction and other depreciable assets. These are all non-current assets. Clear?
Yes.
Okay, then intangible assets are non-financial assets without physical substance. Examples are patents and goodwill. Okay.
Yes.
Yeah. So why we say here non-financial asset? Because when you're having bills receivable, right?
Yeah.
Bills receivable is a financial asset without physical substance. Got it?
Yeah.
So that's why we clearly say that that's a non-financial asset. Patents, goodwill, and all they are non-financial assets. Okay.
Yes.
The current and non-current liabilities. Current liabilities are expected to be settled or liquidated in the ordinary course of business during the longer of the next year or the operating cycle. Generally speaking, current liabilities are expected to be settled or liquidated within 1 year from the balance sheet date. Okay. Then following
Yes.
are the major categories. One, accounts payable or trade payables for items entering into operating cycle. That is, examples are for materials and supplies used in producing goods or services for sale. Means you purchase some materials or anything on credit, then it becomes accounts payable. If you borrowed something from somebody, some other companies, then it becomes other payables. Clear? Or you have outstanding salaries, rents, wages, royalties, etc. There's other payables. Clear?
Yes.
Then unearned revenue arising from collections in advance of delivering goods or performing service. Examples are ticket sales revenue. If, for example, you are taking a flight ticket, okay, you are running a airlines company, correct?
Mm.
So you received somebody, for example, I am going to travel in your aircraft in March, but I took the ticket now. So in the February revenue, can you show my ticket price as your revenue?
No.
No. So when you will convert this as revenue, according to your terms and conditions in the ticket, you might have seen the ticket that before 48, after 48 hours, you can't cancel the tickets, right?
Yeah.
So you have, so in accounting aspect, what we do, we will recognize this revenue 2 days before the ticket is due. Clear?
Yeah.
Okay. Now, so at that time, we will convert this liability to revenue. Okay. Then comes other obligations expected to be liquidated in the ordinary course of business during the longer of the next year or the operating cycle. This includes short-term notes given to acquire capital assets, payments on the current portion of the serial bonds or other non-current debt, then long-term obligations that are or will be callable by the creditor because of the debtor's violation of a provision of the debt agreement in the balance sheet date. This is what, like for example, you have a loan with the bank, which is actually
Mm.
payable after 2 years or 3 years. Okay,
Mm.
but in the loan agreement, there is a few terms. For example, you should have a current asset ratio as 2:1, quick ratio as this. You should have minimum this much inventory, this much AR, blah blah blah. For example, any of this criteria you have violated, for example, okay. And in the loan agreement, it says if you violate any of these clauses, this loan will become immediately payable. Got it?
Full on.
Full loan. Even though it is a long-term loan, automatically it becomes immediately payable. Clear?
Okay.
And on the balance sheet date, you know you have violated some of that.
Mm.
Then you at least you know that this is not a non-current liability. This is a current liability. Correct? So
Mm-hmm.
that's what long-term obligations that are or will become callable by the creditor because of the debtor's violation of a provision in the debt agreement at the balance sheet date. Clear?
Yes.
That possible obligation for warranties or guarantees and estimated returns. Clear?
Yeah.
Okay. Yeah. Next, current liabilities do not include short-term debt if an entity intends to refinance them on a non-current basis and demonstrate an ability to do so. Okay. Now, this is one thing where, for example, on 31st December, you had one accounts payable, which you have to pay like $1 million. Okay. 1 million you have to pay. This is a payable you have. But this is a current liabilities. But after December 31st, on January 15th or 20th, your management have discussed with the bank to refinance only this vendor. Got it? This is a big vendor. You don't have enough money to pay them. So you are going to take a term loan. You're going to take a 3 years loan or 2 years loan to pay. Got it?
Mhm.
But this happens when? Even after the balance sheet date. Got it?
Mhm.
So you completed your books on 31st December, you close it, everything. At that time, it is under 1 million is under current liability. But on 15th of Jan, you made an arrangement with the bank to finance this short-term liability with a long-term liability. Clear?
Okay.
But this happens before the balance sheet is being signed by the auditor. Clear?
Yeah.
Then you have to move it to non-current liability. This particular current liability, this particular vendor's outstanding amount, you have to move to non-current liability. Clear? So current liabilities do not include short-term debt if an entity intends to refinance them on a non-current basis and demonstrate an ability to do so. So the ability to refinance may be demonstrated by entering into a refinancing agreement before the balance sheet is issued. Okay, two things you have to understand is balance sheet preparation and balance sheet issued is different. Balance sheet issue is happening only after the auditor is signing the statement. Clear?
Okay.
Okay. Now, next, non-current liabilities or long-term liabilities are those not qualifying as current. The non-current portions of the following items are reported in the sections of the balance sheet. So non-current notes and bonds. Then LSE's liability under finance and operating lease. So we call it as lease liability, right? Under IFRS 16 also, we call it as lease liabilities. So this is a non-current one. Then deferred tax liabilities arising from inter-period tax allocation. Then obligations under product or service warranty agreements. Then deferred revenue and advances for non-current commitments to provide goods or services. Clear? All good?
Yes.
Yeah. Now comes equity. Okay. So equity represents ownership interest in a firm. Owners of corporations are referred to as stockholders or shareholders. The following are the major types of equity. One is capital contribution by owners, par value of the common and preferred stock issued, and the additional paid in capital. So when you purchase any share from the market or from the company, so you might be paying $50 or $50 for the share, but when they account it as par value as a common stock and additional paid in capital, the different number. Like for example, if $1 is par value, then 49 will be the additional paid in capital. Clear? Okay. Now, so next comes the retained earnings. Retained earnings is the accumulated net income, not yet distributed to owners. So the retained earnings, what happens? All the accumulated profits from the day when the business started, it will be there in the retained earnings. Then dividends can be paid when retained earnings has a balance. Okay. A payment in excess of this balance is a return of capital, not a dividend. Can we do that?
Payment in excess of this. No, I don't know.
Yeah.
Can
Basically,
you?
if you don't have profit, you can't give dividend, right?
Yeah.
Yeah. So, but what happens is some companies will still declare dividend and pay dividends. Why? To make the investors happy. Now, how they will do? They can't. If they are doing, basically, they are not distributing the dividend. They are actually giving back the capital.
Oh, okay.
Got it. So that's why here that can be done, but provided you have enough additional paid-in capital. Clear? One more question I had. So the for example, I invested in a company for 5,000 shares, okay, and the par value was $1, and additional paid in capital was 49. So into this, and then goes into this. The total investment I had in the company is 250,000. My question: can I get my investment back from the company at any point of time? I invested in common stock. Okay, this is a common stock.
The company is winding up and all the other liabilities are paid off.
Yeah, okay, that's one thing. When the company is liquidating and all the other liabilities are paid, even the preference shareholders are paid. If anything is left, we can get this money. Any other
Yeah.
ways we can get this money back?
No?
If the company is listed in the stock market, then you can sell it in the stock market. Correct.
Yeah.
No other way you can take your shares back to the company and say, okay, give me back my money. They will not give. Clear.
Yeah.
Only option you will be having is sell to others. Now, there is one more thing is called treasury stock. Treasury stock is where company doesn't like you as a shareholder. Okay. So company will come and say, Betsy, I'll give you your money back. Give me the shares back. Clear. In only this scenario, you will get your money back from the company. Clear. Directly from the company. If you want to recover this money, you can sell to others. Okay.
Mm.
Yeah. Now,
But
so retained earnings is accumulated net income not yet distributed to owners. Dividends can be paid when retained earnings has a balance. A payment in excess of the balance is a return of capital, not a dividend. So occasionally, the board of directors restricts the retained earnings to prevent payment of dividends. The usual reason is that the board plans to reinvest the earnings in the business. Now, one more question: can the shareholders ask for a dividend?
no.
No, right?
No.
Then, for example, I have invested in a company. Now I want dividend at any cost. What can I do? Anything I can do?
You can only sell the shares and get the money from that.
Okay. I don't want to sell the shares also. Is there any other ways? Can I exercise any of my rights here? What is the right to shareholder? What is the right shareholders having? Basically, the voting rights, right?
Yeah.
No.
But
So there is
only if you have that many amount, like what is
yeah,
that called?
more than 50% majority shareholding.
Majority shareholding. Only then you can exercise that right?
No, I can exercise the voting right in all the meetings, but the result will be based on the other votes also. For example,
Yeah.
I have other friends also, and all of us together is more than 50% shares, and we all
Mm.
voted for what do we say, dividend. We can't vote for dividend first of all. What we can do is we can vote and remove the directors
Okay.
and bring anybody who will obey us.
Okay.
Got it? Then we can ask them to declare dividend. Got it?
Yeah.
Okay. So that's one thing. So if the board is saying they are planning to reinvest, blah blah blah, but still we want the dividend, then we can vote against the board and remove the board of directors in the annual general meeting and bring new people and ask them to declare dividend. Clear? Other than that, even the shareholders doesn't have any right to ask for dividend. They can't go legally also, even if the company is not paying dividend for 200 or 2000 years. Clear?
Yes.
Okay. Now, then comes treasury stock. Is the firm's own stock that has been repurchased. It is reflected in the shareholders' equity as a contra account. Do you know what is a contra account?
Um, like if you take cash from the bank
Yeah,
and
that's actually contra transaction. Cash to bank, bank to cash, petty cash to bank, petty cash to cash and all. That's contra
yeah.
transaction. Contra account is where, for example, we are talking about depreciation, accumulated depreciation. What is the normal balance of an accumulated depreciation? Credit balance or debit balance?
Credit.
Credit balance, correct. So, but accumulated depreciation is credit balance. Yeah, right. So, in the balance sheet, we have fixed assets, right? Fixed asset we are having, and fixed asset we show it as less accumulated depreciation, correct?
Yeah.
Assets value, for example, 100,000 and 50,000 is your accumulated depreciation. So your net assets value will be, or book value will be carrying amount. Carrying amount will be 50,000. Clear? So
Yeah.
ideally, when you have, this is all the asset side, right? In the asset side, everything should be having debit balance, right?
Yeah.
Right. But we are showing the accumulated depreciation on the asset side. Correct.
Yeah.
If I choose to show this on the other side as accumulated depreciation, the credit side, is it okay?
As per the general rules of debit and credit, yes, but
Yes. Correct. Yeah. But according to the reporting standard, it's not correct. Correct.
yeah.
So what we are doing now, we are showing a liability, an asset which is having a credit balance. We are showing it under asset side, which is having a debit balance. So that's why it is a contra asset, contra account. Got it? What we are doing is a contrastic, right? You
Okay.
understood? We are supposed to show here, but we are showing here.
Okay.
Okay? So that's why we call it as a contra account.
Mhm.
So there are a few other contra accounts we have is the sales return. We show under sales minus sales returns, right?
Yeah.
So sales return is actually having debit balance, but we are showing under the credit side, but in a minus symbol, correct?
Yeah.
So when you're putting anything on a other account side or in a negative sign, then we call it as a contra account. Okay, got it?
Okay.
Next, accumulated other comprehensive income or accumulated OCI. That means all comprehensive income items not included in the net income. So we will study in detail what is other comprehensive income the coming part. So when we in that time we will see the format of the income statement. Okay. Next, limitations of balance sheet. Now, limitations of using balance sheet for decision making includes the following: that the balance sheet shows a company's financial position at a single point in time. So, like if you want to manipulate the users, what you can do? You can adjust your payables, you can adjust your receivables, and all those things, right? You
Yeah.
can simply not record any payables or in purchase invoices on the 31st. You will push it one more week. Then you record, correct?
Yeah.
So that will manipulate your current asset and quick asset ratios and all. Quick ratios and current ratios. So accounts may vary significantly a few days before or after the publication of balance sheet. Then many balance sheet items such as property, plant and equipment are recorded at historical cost, which may not equal the fair value. Right?
Yeah.
Then the preparation of the balance sheet requires estimates and management judgment. So this could also go wrong. Right? Like for example, you are providing depreciation. Who decides the asset should be depreciated in 5 years or 3 years? Whose call is that? Management's call, right?
Right.
What if that call is wrong? They, for example, for an asset, I estimated a 10 years life, but the asset is having only 5 years life. Then my whole depreciation will change, right?
Yeah.
Now, the balance sheet omits many items that cannot be recorded objectively but have financial value to the company. Got it?
Yeah.
But one of those examples is that you're providing training to employees. Okay. Basically,
Yeah.
it's a value addition to the company, right?
Yeah.
But you are not showing in the balance sheet. It's expense out.
Yeah.
It's having a value to the company also, right? The training which you provide. That's one
Yes.
example. Next. Let's do as a break. We'll do some question and come back. Okay.
Okay.
It's not a real break, it's as a break. So refreshing. Hmm. How many questions to do? There are 20 questions. We'll do just 4 questions, okay?
Okay.
Okay, come on.
And
In the times of rising prices, what effect does the use of historical cost concept have on as a company's assets value and profit? The time of rising prices, what happens? It's inflation, right?
asset value will be understated and profit overstated.
Profit will be overstated, right? How?
Because sales will be higher, sales value will be higher, right?
Okay. Thing on the side of sales, sales will be overstated, right? That could be correct. Any other options anybody is having? Any other suggestions? No opinion, right? None of them have opinion. Okay, fine. Okay. So in the period of rising prices, use of historical cost concept will cause the value of fixed asset on the financial statements to be understated, since the current replacement cost of the asset will be greater than the amount that was paid for them in the past. The amount expense currently for depreciation will be lower than it would be if those assets have been purchased currently at higher prices. Got it, Betsy? It's not about the
Yes.
sales. The other part is on depreciation. Clear?
Okay.
Okay. Even though you got the correct answer, the assumption was wrong. Got it?
Yeah.
Okay. The lower depreciation expense will cause operating income to be higher than it would be if the asset has been purchased at the current prices. So operating income will be overstated when compared with what it would be as it have been purchased currently. Clear?
Yes.
Okay. So that is why when you
See,
even you get the correct answer,
inventory
you
will
have to.
experience a similar effect. As long as items purchased earlier remain in inventory, when replacement prices increase, the value of the inventory will be understated. So what I said was also true.
Yep.
At
But
the same time, cost of goods sold in the for each sale made will be lower cost that was in the effect of the inventory that was sold was purchased. How
hmm,
much difference that will make will depend on what cost flow assumption is being
something
used, how
you
rapidly the inventory is turning over.
yeah. Why? Because in that aspect we can't give a response. Why? Because we don't know whether we are following LIFO method or FIFO method or weighted average.
Okay.
Even though they are saying if there is an inflation happening, there is impact on the inventory valuation also.
Yeah.
For this particular question, that's a asset that's based on the depreciation impact and the assets value. Got it?
Okay.
Yep. No. Okay. Now going forward next. Okay. All of the following are limitations of the balance sheet except.
Balance sheet provides information on liquidity and solvency. Using management trends and estimates. Balance sheet of its any balance sheet provides information on liquidity and solvency. That's not a limitation.
That's not a limitation, right? Correct. Yeah. Nobody else is studying, right? Nobody, nobody have an opinion also. You don't lose any marks here. Okay, so basically they are asking for the negative, right? So when this kind of question come, what method you should adopt is just hide the word except and try to take all the correct answers. Got it? Find out what are the limitations. That will be the easiest method to do. Otherwise your brain will be confused. Clear?
Mm-hmm. All elements of financial statements as defined in the statement of financial account concepts number 8. Okay.
Is that each of the following are elements of financial statements as defined in the statement of financial accounting concept note, conceptual framework, financial reporting. Elements of financial statement except
Operating income, investments by owners and distributions to owners.
historical cost, right?
Historical cost.
It should be. Okay. Historical cost is not an element of financial statement. Historical cost is one of the method by which items reported in the financial statement should be measured and valued. Okay. Elements of
But
financial
you come in
statements.
the notes, no?
Which one?
In the notes?
No, they are asking elements of financial statements.
Okay.
Okay. Assets and liabilities are an element. Investment by owners and distribution, like dividend and capital, is there. Then comprehensive income and its components is also there. Correct. So elements of financial statements are assets, liabilities, equity, comprehensive income, and its components. Investment by owners, distribution to owners. Clear? Yeah. Next, what is that?
I need calculator.
Yeah. Bond system began operating January and spends 900,000 in the first month of operations as follows. Advertising campaign, computer equipment. Okay. The total cash expenditure that should be capitalized as plant property, equipment, and equipment is how much?
The insurance policy. Cash capitalizes property, plant, and equipment. Building rent 60. Salaries, office supplies, automobile 30. 370.
How you got 370?
Computer equipment, building rent, and automobile.
What is the question? How much you can capitalize, right?
Yeah.
Building rent, can you capitalize?
Under leases, no?
Under leases, but then they will say it as leases, right?
So minus 310.
310, right? Any other opinion by anybody else? Okay. Got it.
Yes.
Okay. 2:30 is the time we set, right?
Yeah.
Okay. Rest of the portion then we will cover in the next class. Okay.
Okay.
But others also please speak up. Huh? Indu, Grace, Shilpa, and Fatima. I think everybody's sleeping. Hello. Hi, Grace.
Here.
You there? Okay.
Yeah.
I thought you're not there. Okay. So let's meet next week then. Okay.
Okay.
All right. Thank
Bye bye.
you.
Yeah. Bye.
Bye.
Bye bye. Thank you so
Bye-bye.
much.
Yeah. Bye.